All right, guys. Well, as always, stoked to be here. Spring has sprung. I hope everybody enjoyed the hot weather over the weekend. I took off, went to St. George, hoping to get some really nice weather, and it ended up being way too hot for me. So I was jealous of the weather you guys had up here. It was in the mid-90s down there, so it was like, you know, hiding out during the day in the AC and then going out and playing in the morning and then again in the evening. But spring sprung, market's taking off. Everybody feeling it?
Yep.
Starting to feel it? Starting to get a little bit of multiple offers and bid over asking, and I'm even still seeing some seller concessions, right? So being able to get, so it's a mixed bag right now with what I'm seeing in the market, and I'm assuming y'all are kind of seeing that and feeling that, but it's about ready to take off. So, and I'm kind of getting flashbacks to where we were at 2020, 2021, and how we need to prepare our buyers, right? Essentially, like this slide shares, bulletproof our buyers, because we don't know quite what they're going to get into. So we want to have them well prepared. We want that Batwoman, Batman belt fully equipped, right? And our, I don't know, anybody hockey fans out there? Wayne Gretzky, do we know who Wayne Gretzky is? Greatest hockey player of all time. He's like the Michael Jordan of hockey. And his famous quote, skate to where the puck is going, not to where it has been. And so he says, good players skate to where the puck's at. Great players skate to where that puck is going. They anticipate it. And so we know things are changing this year, like we've talked. Yeah. We know inflation's coming down, so mortgage rates are coming down. No news to anybody, right? Inventory levels are near all-time low. So all that's going to do is create a buyer demand boom, right? So we got to be prepared for that, get our clients prepared for that. Now, I shared this slide, this NerdWallet survey earlier this year, but I feel like it's really important to kind of bring back up some key points here. In this survey, 2/3 of the buyers, prospective buyers, felt an imminent housing crash. Like, we're going to crash. It's '08 all over again, right? With the spike in appreciation we've had over the last couple of years. This is what our consumers are feeling right now. Mortgage rates are unprecedented, meaning never been this high, right? Basically two out of three said that. And then 57% said mortgage rates will be higher this year. And we all know that that's not going to be true as they've started to come down. Inflation's poised, and everybody remember, circle next Wednesday, the 10th. That's going to be April's inflation print. That's not going to be the destination. That's not Mexico, right? That's us getting on the airplane, and that's inflation going to start coming down at a rapid pace this summer, and mortgage rates are going to follow very, very quickly. So this is the idea, and this is, you know, the thought that our clients are having in their minds, and we got to get out in front of that and help educate them again, right? So the solution, become a bulletproof buyer, and this is what we were in full force doing in 2020, 2021. But the key thing here is an upfront market analysis. So with our clients, we want to teach them where the market has been, where it's at, and where it's going, right? Oh, and if anybody wants these slides after, let me know. I can email this presentation over to you so that you've got them to share with your clients. But with all of our clients, we like to get them to understand the why behind something. And when somebody's uneducated on something, they're a little bit just kind of stuck, right? A little fearful, a little stuck. When they become educated and they understand the why behind something, no matter what it is, real estate related or not, they're confident and they're compelled to take action. Where there's fear, there's crippling, right? But when we're confident, we're compelled to take action. So we want them to understand what's going on in the market and why. Also here, we might be getting back into appraisal gaps for a couple of different reasons, right? Either the market's appreciating faster than the appraisals can keep up, or we've got a bid over ask. So we want to have our clients prepared for if there's a appraisal gap, how do we handle it before the offer even goes in? And again, we don't quite know what the listing's going to require. We might still get a good, price reduction and credits, or we may have a multiple offer situation, have to compete with cash. So we want our clients ready to go on that. We also had a closing recently with Jen and Brandy Lucas, where we did this fully underwritten approval up front. So got somebody through conditional loan approval, closed in 3 weeks. So it's something to where we can offer that to our clients, get them fully underwritten. It's a little bit slower process up front, but once they're through conditional loan approval, they're ready to go write an offer and be able to compete, and be the quickest one to the closing table. And then the last key point I wanted to discuss today was the ability to submit all cash offers. So at NEO, we've got a couple of really cool programs. We've got a bridge program, and we've got a cash buyer program. And I'll kind of go into the details here in just a bit. I'm condensing an hour-long presentation, trying to be mindful of time in about 10 minutes. So if I'm moving too quickly for anybody and you want to have a one-on-one to talk through any of these key points, please get with me. We'll schedule some time. Now, as part of the upfront market analysis, I wanted to pull out a couple of slides here that I really feel are impactful. This one is a chart that goes back year-over-year appreciation back to 1942 when we started tracking this information. All those green boxes are year-over-year appreciation numbers, meaning positive. Red's going to be negative, and back in 55 we had the one flat year. So that in an 81 year, this would be the 82nd year, the record, I don't know if we're going to be able to see this, let me get rid of that, 73 winning years, 7 losing years, and 1 tie. Anybody in here an NBA fan or maybe even a WNBA fan? This would be a better record than anybody in NBA or WNBA history. So meaning that real estate's the champ, and it's an amazing opportunity for people to grow wealthier, right? Just want to make sure you got that pick. Okay, all right. So the next thing I like to show them is a lot of our clients, maybe the move-up clients, they lived through the 08 crash. Or maybe their children that are now buying homes. Remember mom and dad going through a rough time in 08, right? The millennial generations are first-time home buyers right now. So what I like to educate clients on is where the market was that led up to 08 and where we're at now, and how we're so completely different. It's polar opposite of markets. And just speaking to unemployment, it rose to 10% in September of 2009, which was the highest unemployment rate nationally since 1982. Unemployment rates right now nationally are 3.6 in Salt Lake County. It's 2.2%. So unemployment's ridiculously low. 20 million more jobs in the country now than there was back then. One of the biggest candidates as to why the housing market crashed, subprime mortgage loans. Anybody writing or doing real estate back then, right? Remember subprime loans? Day out of bankruptcy or foreclosure, 100% financing, right? Yep, 1 year interest only with a balloon, right? Market started dipping value-wise, and then you couldn't refinance your home or sell it, walked away from it, and that was the domino effect. They really don't even exist today. The cumulative new home construction, so this is 5 years prior to the crash, over 7.5 million units were constructed. Today we're about 4.6 with the 5 years leading up to now. So 40% less new builds. And then inventory on the market peaked at 4 million back then. Right now we have less than 1 million, and a third of those are under contract. So really nationally there's just over 600,000 homes actively listed for sale. Then mortgage delinquencies, 10% to 2.8. And here's a key one too, homes in foreclosure, 4.6, and now we're at 0.6. So a drastically different market than what we had in the years leading up to 08. And kind of going back to the NerdWallet survey, 67% feel a housing crash is imminent. With just these statistics alone, I don't know how that can happen, right? Now, kind of speaking to the appraisal gap strategy, why might appraisals start coming in low? Either we're, the market's moving too fast, appreciation's happening too quickly, because an appraiser looks in the rear view. Us as real estate mortgage professionals and buyers and sellers, we look in the windshield. Right? And so what happens is, especially in 2020 and 2021, appreciation happened so quickly that the appraisers, the data, the historic data, couldn't catch up or keep up. So what we want to do is be able to speak to our clients about an appraisal gap strategy. Again, depending on the listing, right? It's multiple offers. We may have to bid over asking. There's a high likelihood that the appraisals will start coming in a little bit low. And then the one key thing about an appraisal gap strategy as well is that if we're competing against cash offers, which a third of the homes sold last year nationally were cash, so high likelihood we're going to get back into a similar market, that we've got to have them prepared for an appraisal gap strategy to where they may even feel confident in removing that contingency right out of the gate, making their offer a little bit more desirable. Here's an example, and this was actually for a client a little over a year ago. Column on the left, column number one, $800,000 price, $800,000 value. They were planning to put 20% down to avoid mortgage insurance. And their payment was roughly $4,600 and cash to close roughly $175,000. That was their expectation. Appraisal came in $75,000 low. And to somebody that didn't already have an appraisal gap strategy, that's probably going to cripple them. Because they're thinking, well, I need to put 20% down. Now I've got a $75,000 gap in value versus purchase price. Well, with already coming into the offer with the idea this is probably going to come in low, here's a backup plan, here's plan B, scenario 2, we take their $160,000 down payment, $75,000 of that goes to the gap, so they're left with $85,000 on an $800,000 price point. You're roughly 11% down. Buy out the mortgage insurance, monthly payments spot on, and so is their cash to close. So it kept them in the game, met their initial expectations, even though the appraisal came in low. So this is something we like to discuss with our clients and kind of have a plan in place already, so that when the appraisal does come in low, they're like, yeah, we expected it. Here's plan B. Let's move forward and close. Now, speaking of fully underwritten approvals, again, a third of the homes sold last year were cash. So how do finance buyers compete in that market? Well, it's complete the pre-underwriting process. So get credit, income, and asset all reviewed and approved. Get your conditional approval done. That way it's a collateral underwrite, meaning just title, appraisal, homeowner's insurance. We may have to update pay stubs or bank statements depending on how much time goes on. So there's 3 asks that we have of our clients that want to go through this process, because it takes a lot of time and man hours for NEO to do this on our dime, about $1,000 worth of man hours. So we ask them, are you going to be actively making offers in the next 60 days? Right, because a lot of things are date sensitive. If they're 6 months to a year out, that's great. We'll do this exercise as we get closer to that. And then are they ready to provide all the documentation needed to get fully underwritten and approved? Right, and then are we the right lender for them? Are they committed to us? We ask for their verbal commitment. We can't legally bind them to anything, but we like to say, hey, are we the right lender for you? Are you guys still shopping? If you are, great, we'll do our traditional pre-approval. But if you want to go through with this, we ask for their verbal commitment. Because of the time and the cost that NEO takes on, we're committed to them. We want to make sure they're committed to us. Now, NEO's got some really cool bank programs. We've got a bridge loan. It's going to help you get from the departing to the new quicker, right? And then we've also got a really cool cash buyer program as well. A couple of different scenarios would be if your client needs to sell their departing in order to qualify for the new, our team Home Solutions will go in and pay cash. Buyer moves in, has 6 months to renovate, clean, stage their departing residence, and while all that's going on, right, you represent Home Solutions on the purchase. So when they buy it in cash, you get paid at that point. Now you can focus your time and energy on getting their listing ready to go. Buyer moves in, vacates that property for you so that you can show it in its best light and maximize on the sales price for it. And while all that's happening, I'm working on their purchase loan. They're going to buy it back from Home Solutions once their departing residence sells for the same exact penny that Home Solutions pays. Go ahead, if you got a question.
So, that's awesome, by the way. How much are they getting for that purchase? So if there's like a handoff, like what are they?
So Home Solutions cost, it's roughly 2.25% of the purchase price.
We're giving them money to purchase cash, right, like property, so that they can move out.
Yep.
And then we're renovating it and fixing it up and making it smell pretty.
Yep.
What is that price that they're, like, what are they willing to give them for that? Is it just based on appraisal?
So like, are you saying like purchase price? Like what home, if the deal makes sense, we'll do it. $2 million purchase price, like it's just, there's not a cap on it. Okay. It's just like if the transaction makes sense and they're comfortable with it, then yeah, they'll do it. It's all case by case, but there's really no hard cap on the purchase price for that cash buyer. Okay. Another scenario would be like, let's say I have 20% to put down on a home, but I'm competing with cash and I want to write a cash offer. I can go that route. And while Home Solutions is purchasing the home for me, I'm on the back end working, getting their purchase loan ready to go so that they can move in once Home Solutions closes on it. Again, you guys get paid at that point. They buy it back, like a for sale by owner kind of thing from Home Solutions. But while Home Solutions is going through the process to buy the home for them, I'm working on their purchase loan, ordering title work, appraisal, so that we're closing shortly after. But if they've got to compete with cash and they've only, say, got 20% down, that's what Home Solutions is going to require that they put in escrow, is at least 20%. They'll go in and pay cash for the home, move the buyer in, and then I'll close their purchase loan shortly thereafter, buying it back from Home Solutions. So there's a lot of details, right? Like if you guys have clients in this scenario and want to learn more about it, let's schedule some one-on-one time. But a lot of cool flexibility with that. It's really just if it makes sense, let's rock and roll, right? Now, how many of you guys have heard, maybe have a family member, friend, or a client that's like, I'm just going to wait, market's going to dip, rates are going to drop, I'm going to wait. Everybody should be raising their hands. I love talking to those clients because this is our software. It's a total cost analysis. And what I like to show them is the cost of waiting. right? So on the left, column number 1 is the buy now option, right? 600,000 is the price, 5% down, pretty traditional conventional scenario here. Well, let's say they wanted to wait a year to buy. Appreciation is, a mere 5%. Now that $600,000 price is now $630,000, which means their 5% down increases, their loan amount increases. But if you look at the payment in scenario 2 as compared to scenario 1, it's actually a lower payment. So to that client, they're like, well, God, I should wait. Well, let's take a look at scenario 3. It's buy now, but then refi in the future at that same interest rate. You're borrowing less dollars, so your loan to value is lower. Your mortgage insurance premium is going to be lower. It's going to drop off sooner. And your monthly payment, by the way, is $235 less per month. So the swing in payment there is going to be over $400 from what you'd be paying today versus what you're going to pay if rates drop 1% as they're anticipated to. But again, you're locking in the price today. So I love the clients that are like, I'm just going to wait. Market's going to crash. Rates are going to drop. I'll wait till then. Love to show them this presentation. And this is just another way of looking at it, the monthly payment difference, right? Scenario 2 is the baseline. So if you buy in a year, yeah, you might be saving $176 as compared to the loan today. But as compared to the refi at that same time, $235 difference per month. And then amplifies over 5 years here, the total cost savings. Column 1's obviously a little bit irrelevant, so the comparison is now column 2 versus column 3. And the net worth in 5 years too. So you've got a significantly higher net worth. This is anticipating a 4% annual appreciation, so a little bit conservative. But I love showing clients this that are like, hey, I'm on the fence. I'm going to wait. And then lastly, I like to categorize leads as 4 different types. How many of you pretty much when you send it to your referral partner, your lending partner, it's their number 2 ready to get pre-approved, right? Is that typically when you guys send somebody over? I love all 4. Number 1 is the kind of not sure, not ready, right? Because then I'm going to show them the cost of waiting. Number 2 is going to be the ready, pre-approved. Great, those are great. We love motivated clients, but I love number 3 and 4 because I like to challenge their mindset and what they're thinking of the market. Decide it's not the right time. Okay, well, great. Why is it not the right time? Educate them on the market. And how many of you have ever worked with a client like that they're 6 months to a year out, but then they get a pre-approval letter in hand? What are they doing the next weekend? They're calling you to go house hunting, right? So I would encourage you guys to refer to whoever you like to refer your business to, these 4 different lead types. Anybody that's not sure, anybody that's ready to go, or decided it's not the right time. But what I would ask you to do is rephrase how you're referring them. Don't say you need to talk to my loan officer. I think that term, a lot of people get the used car salesman vibe from. I would say talk to my finance team, they're great. They're going to help you identify where you're at, where you want to be, and build a bridge in between. Give you a roadmap how to get there, and we're going to be here every step of the way to get you there. Whether it's now or whether it's a year from now, get with my finance team. So that's how I would recommend introducing people. Yeah, I work with Calendly, so I have agents that will click on my Calendly when they're with the client and say, okay, Matt has an opening 2 o'clock on Tuesday. Does that work for you? Great. Enter their information. You could submit notes, and then they'll get an email, a text. Hey, you've got a call coming up with Matt.
Will you send me your Calendly link for the notes so that it's accessible for the agents to schedule
You bet.
appointments?
You bet. Cool.
All right.
Any other thoughts, guys? Okay. Well, cool. I hope that gives you a little insight.